So you're self-employed and don't have an employer-sponsored 401k plan. How do you save for retirement? There's plenty of ways. Let's dig in and find out together. So the first thing to understand is there's actually three different types of tax status for investment accounts. So you can have tax-deferred accounts, taxable accounts, or tax-free accounts. And which one you use depends on your personal situation. Those tax-deferred accounts include traditional IRAs, SEP IRAs, simple IRAs, individual 401ks, and then health savings account. Most people don't realize that health savings accounts after age 65 can be used for any expenses, including your day-to-day living expenses for retirement. So they can act double duty as both a health savings account and as a retirement account. For the tax-free accounts, this is anything with Roth in the title of the account, which includes Roth IRAs, Roth I-401ks. Just recently, Congress passed rules to allow for Roth simple IRAs. And again, HSAs, those are tax-free, but only when they're used for healthcare expenses. And then there's also 529s. That's a college savings account, but that's also tax-free. So today, what we're going to focus on are the retirement accounts specifically. However, we're going to exclude the simple IRA simply because there are more competitive and better accounts available for self-employed individuals. Now, whether you go for a tax-deferred account or a tax-free account really depends on what your tax bracket is. And so the middle column, MFJ, stands for married filing joint. The far right column is if you are filing your taxes as a single individual. And then you see the federal income tax brackets on the left-hand column. If your income puts you in the lower tax brackets, 10, 12, and usually even 22%, it usually makes sense to pay taxes now in the form of a contribution to a Roth account, and then you get tax-free growth into the future. Let's say, however, that you have high income currently and you're in the 32, 35, 37% tax bracket. Well, that's a pretty high tax rate. And so any tax deduction that you can get today is really beneficial. And so if you're in those higher tax brackets, it probably makes sense to utilize a tax-deferred account instead, where you are literally deferring income and the taxes on that income until you take that money out in retirement. And then at that point, you'd be taxed on that money, hopefully at a lower tax bracket in your retirement years. Let's do a quick example, though, of the Roth accounts and why this can be so beneficial. A good way to think about this is an apple tree. Basically, you are paying taxes on the seed for that tree, but all of the fruit comes out tax-free. And here's how that can really pay off. So let's use the Roth IRA as an example. So for a 30-year-old putting in the maximum contribution, let's say that earns 7% return annually. And that's going to grow by age 61 to about $726,000. Now, that exact same contribution going into a taxable account that has the exact same 7% return would be worth over $200,000 less just from that the tax savings on that Roth IRA. Now, for a married couple where they each have a Roth IRA, that's over $400,000 of tax-free benefit that you get over and above a taxable account. So you can literally buy a house with just the tax savings by saving in the right type of an account. So for self-employed folks, these are really the choices that it boils down to. So you can make a contribution to both an IRA type of an account, either traditional or Roth IRA, and you can also make a contribution to a employer-sponsored retirement account. So a SEP IRA stands for Simplified Employee Pension IRA. That's an employer-sponsored account, as is an individual 401k. That's for self-employed people only that don't have any employees. So you can make contributions to both of these types. You see the limits there. $6,500 is the both traditional and Roth IRA limit for 2023. And then the SEP IRA and individual 401k have higher limits, being an employer-sponsored plan. Now, because the individual 401k is both an employee and an employer contribution that's allowed to that account, it tends to have much higher contribution limits than the SEP IRA, which is employer contribution only. Really, the only downside of that individual 401k is that once that plan exceeds $250,000, you do need to file an extra form with the IRS each year called the 5500 EZ. It's a very basic, straightforward form to just simply report on the assets, liabilities, and data for that individual 401k plan. Now, once you've chosen your account, now we need to decide how to invest the money that's in that account. So here are the basic choices. We can hold it in cash, you can buy some bonds, buy some stocks, or really what most people do is they'll use mutual funds or exchange traded funds, which can be either stock funds or bond funds. Now, here's how those mutual funds and exchange traded funds work. Basically, every share of that fund that you own, you get a tiny little slice of all of the stock or all the bonds that are inside of that, that fund. What you see on the right side, this is the S&P 500 index from a couple of years ago. And so every share of that index fund buys some Apple, some Microsoft, some Amazon, some Facebook, etc. So let's talk about the difference then between stocks and bonds. Stocks are where the growth is going to come from in your portfolio, but it tends to also come along with a hefty dose of risk too. And so the dark blue line where you see bouncing up and down, that is the US stock market over the past few years. The light blue line is the US bond market. And so that line, yes, it's much more stable, but it also does not include the long-term growth like stocks do. Now, stock market can have some ups and downs. So each blue box on this chart represents a year when stocks were up. The red boxes represent a year when stocks were down. So roughly 3/4 of the time, stocks are up year over year. Now, as an investor, this is where we get into trouble because our emotions and feelings jump into our portfolio. And so what most people go through is they say, gosh, I want to, market's going up, get me in. I don't want to miss out on this. But as the market's coming down, we do the exact opposite. Get me out. I can't lose any more. And really that emotion drives us to making decisions that are exactly opposite of what we should be doing. We want to be buying low and selling high, not buying high and selling low. And so one way to help with that is to stick with an asset allocation that's appropriate for you. So for example, if you are closer to retirement, it makes more sense to have more bonds in your portfolio. So on the left side of the screen, you see a portfolio that is roughly 60% stocks, 40% bonds. And in this way, if the stock market does poorly, we can rely on the bond side of the portfolio to provide some income that may be needed in the near future. On the right side, this would be more appropriate allocation for somebody who's much younger or farther away from retirement, typically at least 5 years, preferably 10 years plus away from retirement. They can afford to have much more stock in the portfolio because we're not going to be taking money out of that portfolio for a number of years. And so it's okay then to ride the ups and downs of the stock market. So once you have your asset allocation, that's your mix of stocks to bonds, now we need to actually choose the funds and the investments to create that asset allocation. So I'd already mentioned mutual funds and exchange traded funds, but there's we can dice that up a little bit further. There are some funds that are actively managed, where a fund manager will actually make choices of, I want to sell this stock and buy this stock within inside of the fund. There are similarly, there are funds that are passively managed that simply follow an index. So the S&P 500 index is one of the index that's most widely followed, and that's the 500 largest companies in the US. And so an S&P 500 index fund would simply own all 500 of those companies, and then the performance is based on the performance of those 500 stocks. Now, another easy way to do this is to utilize what's called a target date fund. And so a target date fund, you'll know it's a target date fund because it has a year in the name of the fund itself. And the way that these are designed is that as you get closer and closer to that year, representing the approximate year of retirement, the mixture of stocks to bonds inside of that fund becomes more and more conservative as retirement approaches. And so this can be a great way, especially if you're just starting to invest, to get started. Now, where can you open up accounts? If you're a do-it-yourselfer, the Vanguards, Fidelities, and Schwabs of the world do have online options to open up accounts. If you do need some advisor assistance or full service options, we do have that available. So wismedfinancial.org/investment-management, and I'd be happy to meet you there. With that, thank you for joining me today. If you do have any questions, feel free to reach out, and I look forward to speaking with you soon. Have a great day. Bye-bye.